Over the course of the last several weeks, we've been talking about this ongoing consolidation process. And in particular, we were talking about in the last 2 weeks that we increased equity exposure when the markets broke above the 100-day moving average, and we added some exposure to portfolios. Now, since then, the markets didn't do a whole lot, but yesterday the markets did break out of this little bit of consolidation. So that's good, positive news. Now, we want to be a little bit careful about this because we've seen these breakouts before. Just last week, the markets broke to the downside, and we were concerned that maybe that consolidation had a negative outcome to it because of potential over Italy, the bank crisis there as well. And of course, that was completely resolved the next day. It was like it never happened, and we were right back to where we were the day before. So we want to be careful with these very short-term moves because sometimes they can lead to what's called a head fake or a whipsaw. And that is why people a lot of times say, well, technical analysis doesn't work. Well, what the reason they say that is because they get whipsawed out of a position because they are reading their analysis incorrectly. And so they just assume that since it didn't work one time for some reason that, well, it doesn't work at all. So obviously don't do it. All you can do is just buy and hold stocks.
So Lance, on the upside, when you show that breakout,
yep,
you're not seeing a lot of conviction behind these up moves, are you, as far as what we call breadth or volume on the market?
Exactly right. But nonetheless, though, we have broken out of that, and if we can maintain above that average or above this area, this previous consolidation through the end of Friday, we can certainly expect that this market's going to try to make it back to 2,800, which was the previous kind of tops that we set back in early January and early February on these rallies. So there is a bit of upside here at this point, and we certainly want to be cautious of that. We're going to run into a lot of resistance that we need to clear before we can actually move higher. So, but to Rich's point, he's absolutely right, is that the action over the last couple of days has not been real broad in terms of what they say is breadth, or in other words, participation. Let's take a look, and I can show you this very easily by taking a look at the markets just even today. So the markets were up today, which was good news. But take a look at this. Out of the 10 sectors of the S&P 500, only 4 of them were positive. So 40% of the sectors were positive, 60% were negative today, and yet the market eked out a little bit of a gain today. So to Rich's point, participation has not been real strong here. In fact, the real participation has been very negative. It's been very narrow. It's primarily been technology and discretionary stocks. Outside of that, and you can take a look at this, here's technology. You see it making all-time highs here. Discretionary is right back to near making all-time highs. But take a look at material sectors. It's basically still in a very negative downtrend. Industrials, which was up today, still a very negative downtrend in those areas as well. Energy has been doing a little bit better, but it's basically still in a long-term downtrend right now from the 2014 highs. And recently, it just set a double top from its previous run earlier this year, and now starting to reverse that run as well. Consumer staples continues to be a major laggard. So when we start, and to Rich's point, when we start talking about the market, what you're not seeing is a lot of conviction in the market in terms of participation. And if you're going to have a strong bull market, in other words, a resumption of a strongly trending bull market, what you need is broader participation within the overall market, and that we just don't have yet. So the risk here, and to Rich's point, and it's a really good point, is that in the very short term, we could well see this market break out and potentially make a little bit of a run higher here. But there's a real risk with not only the what's going on with trade wars and tariffs, but also geopolitical risk, what's going on with Italy. And I wrote an article last week, and it's in our newsletter as well, talking about the risk of Deutsche Bank and the risk of Italy. There is a lot of financial risk in the markets. Now, what triggers financial risk is interest rates. What's happening with interest rates? Interest rates are going up. The Fed's tightening interest rates. LIBOR has spiked sharply. And the important thing here to remember is a bank like Deutsche Bank, as an example, they have a huge amount of derivatives. So the problem with derivatives and with a lot of these more exotic products is that they are linked to a specific commodity, right, or price. A lot of cases, it's interest rates, or it could be linked to real estate prices, or it could be linked to a variety of other things. And when the math, or when those instruments get out of whack, that's when bad things happen. Well, there are trillions, literally trillions of dollars worth of products linked to LIBOR. LIBOR's been spiking. If it stays, if LIBOR continues to spike, or the dollar runs counter to how these other products are structured, and we start getting spreads that blow out of what they call normal ranges, well, that's where financial crises happen. And the problem is you don't know when that crisis point is, because we don't know how all these things are interlaced. That's what happened back in 2007. We saw Bear Stearns basically go under as their mortgage derivative products blew up. We ignored that risk, and then several months later, we have Lehman and, of course, the financial crisis. Deutsche Bank looks a whole lot like Bear Stearns and like Lehman back in 2007. So the point here is not to disregard those risks. And to Rich's point just a second ago, with the breadth of the market very narrow here in terms of this advance, yes, the markets could move higher, but if we don't start getting broader based participation, this could be a very short-lived rally. We're still on a weekly sell signal. Long-term trends are still basically flat. And currently right now, and really since the beginning of the year, the markets have really not made much progress. We've just been trading within a fairly large range right now on the markets itself. So again, while we're going to increase some exposure most likely in the course of the next week or so if markets continue to improve, we're still going to be holding excess levels of cash. We're still hedging risk as necessary, and we are paying attention to the downside risk. So if things reverse, we will be hedging those risks off the table, and we will certainly be relaying that to you so you can do the same. But if you get by the website, realinvestmentadvice.com, where we're happy to answer any questions that you have, simply send us a question. If you need to schedule an appointment with myself or Rich or Danny and talk about your financial situation, happy to do that as well, because again, what's most important is to make sure you're doing the right thing with your money. realinvestmentadvice.com. Get our latest blog posts and more at the website. Our Technically Speaking post is out right now as well, talking about exactly this. Go to the website now, realinvestmentadvice.com. We'll be right back after the break with more of the Real Investment Hour with Richard Rosso and Danny Ratliff, Certified Financial Planners, right after the break.
Follow Lance on Twitter @Lance Roberts or go to realinvestmentadvice.com.